Hello, welcome to today's lecture. Today we're going to cover Chapter 15, Stockholders' Equity. This chapter's the primary purpose is to cover accounting issues related to capital contributions by owners and the means by which profits are distributed through dividends. We will cover multiple areas here, including common stock, preferred stock, treasury stock, and then also for dividends, including cash dividends, liquidating dividends, property dividends, and stock dividends. Due to the amount of material we have to cover in this chapter, I will be breaking up the lectures into multiple recordings, so you will need to listen to three, I believe, is what I'm planning for you to get all the information necessary to complete your note handout packet and then also to assist you in completing your homework, taking your quiz, and preparing for the first exam. To give you a little background first as we get going here on the structure of the note packet and how I'm planning on these lectures working, you have been given a substantial amount of the information already within the note packet. However, as we progress throughout the lecture, you will need to take notes and handwrite or type if you're using this on your computer information for the examples and also definitions and other key tips that I provide you that will assist you throughout the course and completing the materials for this chapter. This is my first time using this software and doing this method of a recording, so please bear with me as I get my bearings here through the first few chapters. One benefit I believe will come from these recordings and this method that I'm using is that you will be allowed to listen to them and watch them over and over again as you need to prepare yourself for the exams, the quizzes, the homework, but also to make sure you're capturing all the information we go through during the lecture. I will try to pace myself as I go out to give you time to handwrite your notes down. However, in the case that I do not provide enough time, you will be able to go back and listen to the lecture again to make sure you're capturing all of the necessary information. Now, let's get started. First, let's discuss the corporate form of the organization. So, there are three forms of a business organization, with the corporation being by far the most dominant form of the business organization. There are special characteristics that apply to corporations that can affect the accounting that is followed by those corporations. First, the corporations are heavily influenced by state laws. The corporation, once established, is recognized as a legal entity subject to the state law in the state in which it is incorporated. These laws govern the owner's equity transactions and are normally set out in the State Business Corporation Act. The main thing to take away from the state law involvement in corporations is that they often restrict and limit what decisions and actions the corporation undertakes. For example, a corporation may wish to dividend 50% of its retained earnings to stockholders. However, a state law may restrict that and limit the amount that they can distribute as a dividend to 20%, so the company is not distributing such a high percentage of their earned capital. Next, the use of capital stock or share system. And this is that each share represents an ownership right with certain characteristics and certain rights, and this is within a single class of stock and in the absence of any restrictive provisions. We'll discuss some of the restrictive provisions later in this chapter when we talked about preferred stock and kind of the preference that they tend to get in certain circumstances. But with respect to this, one ownership right is that you can share proportionally in the profits and losses. Therefore, if a company is doing well and generating money, then you are more likely to receive a dividend. And second, with that, if the company is doing well, it is more likely that their stock is also increasing, which then increases the value of your ownership because your shares have increased in value. Therefore, if you were to go sell this on the open market, you would receive a better return on your shares than what you had paid initially. Next is to share proportionally in management and then the vote. One key aspect of this is that you often have the ability to make decisions for the corporation with regards to their management, specifically ownership rights. In this example, include being able to partake in the voting of who the board of directors are for the corporation, or if a company is allowed to undertake certain acquisition or merge with a certain company. Often these are situations which require stockholders' votes, and this is one ownership right that is given with the share system. Next is to share proportionally in corporate assets upon liquidation. This just refers to the process of if a company is liquidated, the fact that if assets remain, the common shareholders will receive assets to back their shares. We will discuss this in a little more detail as we get into common stock and preferred stock, specifically in the order of preference. And last is that the company would that your ownership right is to share proportionally in any new issues of stock in the same class. This is referred to as the preemptive right. And in this circumstance, essentially what the preemptive right is that it allows existing shareholders to maintain their current ownership percentage by buying a percentage of the new shares. To put this in perspective of why this is a significant right that is given to shareholders, if you own 10% of the shares of a corporation and they issue an additional amount of shares, and if you do not buy any of those shares, your ownership percentage may go from 10% of the company to 5% of the company. Therefore, the preemptive right allows you to purchase a certain amount of shares you need to at the current rate, not the rate you paid previously, in order for you to balance your ownership and maintain the same level of ownership percentage that you had prior to the company issuing new stock. Next, we'll go to the development of a variety of ownership interests. And so, specifically in this chapter, we're going to cover common stock, preferred stock, and treasury stock. We'll discuss in this lecture a majority of the time spending about common stock. And treasury stock will be in the second lecture, and then preferred stock we will discuss in further detail in the third section. First, with respect to common stock, it represents the most basic ownership in a company. The key takeaway here is to make sure you understand that common stockholders are considered to hold a residual interest in the corporation. And what this means is that in the event that a company is liquidated, the common stockholders would receive any amounts left over that were not distributed to creditors and preferred stockholders. And the easiest way I find to remember this, the residual interest, is that you get what is left. Therefore, you have an interest in the corporation, but it only applies in certain circumstances if the company has assets to provide you upon liquidation. While this is one downside, is that creditors and preferred stockholders are in front of you if a company is liquidated. The benefit to common stockholders that is not granted to preferred stockholders and creditors is the fact that common stockholders generally control the management of a corporation and tend to profit the most if the company is successful. Therefore, with common stock, it is the highest risk of ownership. However, it provides for the highest rewards. And just to provide a little bit of background, with respect to common stock, corporations can have multiple classes of common stock, and these common stock classes can provide different rights. For purposes of this course, you will not be asked to distinguish between different stacks or different classes of common stock. We will just assume in all examples that there's only one class of common stock to make things simple. Next, let's go on to preferred stock. Preferred stock is the term used to describe a class of stock that possesses certain preferences or features not possessed by the common stock. We will discuss this further on later in the chapter, but I just wanted to give you a brief outline here while we are in this section. Next, let's go to corporate capital. Under corporate capital, a stockholder's interest in a company is a residual interest, i.e., what's left over, as we just discussed. And also to take away here, I want to make sure everyone remembers the basic accounting equation that I hope has been drilled into your minds over your previous accounting courses. But assets minus liabilities equals stockholders' equity. You will see when we start to do examples, I have specifically laid out T accounts where every example starts with this basic formula so you can remember how you should be balancing your T accounts and in which directions, debits or credits, whether they increase or decrease. This is specifically important in this chapter for stockholders' equity, as you will be asked on exams to understand how stockholders' equity has been changed or impacted by certain transactions. Now let's discuss the primary sources of equity. First, we have contributed capital. And contributed capital is referred to as paid in capital, and it is the total amount that you paid for the stock. If you paid $50 for one share of stock, this amount is allocated between the capital stock and the additional paid in capital. First, the capital stock refers to the balances in the account that reflect the par value of the shared issues. So, for example, in the circumstance where you paid $50 for one share, assume that the par value of that share was $10. Therefore, $10 of your 50 is recorded into the capital stock common stock account. The remaining $40, the difference between what you paid at 50 and the $10 recorded into capital stock, is reflected in additional paid in capital. Additional paid in capital represents the amount paid for stock in excess of par value. Therefore, it is the difference between the fair market value and the par amount for the share. Therefore, in this example, the fair market value of the share was $50, which is what you paid, minus the $10 par value, which was recorded in the capital stock account, and therefore you are left with 40. We will go through an example here shortly, and you can see the T account and journal entries and how that balances. Another source of equity is earned capital, primarily referred to as retained earnings. Retained earnings are accumulated earnings over time that the company has not distributed to shareholders. As you can see in the chart below, earned capital is made up of unappropriated and appropriated retained earnings. We will discuss restricted retained earnings later in this chapter, but essentially what it is there is a segment of your retained earnings that the company has earmarked as restricted, and therefore they have to account for it in a separate account. Now back to other comprehensive income. You will not be asked to know any more information on other comprehensive income other than what is stated right here. I just wanted to give you another idea of something that impacts the company. And other comprehensive income is a change in owner value arising from non-owner transactions. And these non-owner transactions have not yet flowed through net income. For example, foreign currency translation. If you are holding a security for 5 years, over that 5 years, the foreign currency, if it is being translated from US to, say, pesos, will change. Therefore, instead of recognizing gains and losses immediately on that, oftentimes you're allowed to recognize it as an unrealized gain or loss. And then at the end, when the security matures or it is sold, then you would recognize the gain or loss and it would flow through net income. This illustration below is a good tool to reference as you complete your homework and your quiz and prepare for the exam. This illustrates the basic structure and components of a company's capital, and therefore I just wanted to make sure that you had this as a reference tool as you complete the course materials. One note I would like to make is that owner transactions do not flow through net income or expense. There is one exception to this, and it is property dividends, and that is not always the case with property dividends, but there is a instance when it does impact net income through expense. Well, we will discuss that later on in this chapter. Next, let's go into accounting for the issuance of stock. First, we have par value stock. And the par value stock is broken down into par value and paid in capital in excess of par, or additional paid in capital is what we referred to it earlier. The par value of a stock has no relationship to its fair value. The par value is often very low on common stock, and it represents the minimum legal responsibility of the owner. As in my previous example, when you purchased a stock for $50 and the par value was $10, as you can see, that $10 has no relationship to the fair value of $50 when you record the entry in the common stock account. The second part of par value stock refers to additional paid in capital. This is the amount of fair value that exceeds par. And as in my previous example, that was the $40, as you paid 50 and 10 of that was recognized as par value. Thus the 40 was the amount that exceeded par. As an example, and this is the most basic example that you will see for common stock. Corporation A is issued 1,000 shares of $10 par value common stock for $50 per share. Therefore, you need to break down this problem into what you know. We know that common stock, you book the par amount into common stock, and for additional paid in capital, you recognize the excess of par in that account. Therefore, on the day that this is issued, the company recognizes a increase in equity of common stock of 1,000 recognizes an increase in common stock of $10,000. This is reflecting the 1,000 shares that were issued times the $10 par value. This is very key concept to understand between what goes into common stock and what goes into additional paid in capital. One thing that will help you make sure you understand this is that the common stock and the preferred stock, the capital stock accounts, are always reflected at the par value. And then next, we know that we issued 1,000 shares and we received $50 per share. Therefore, we received $50,000 in cash for issuing these 1,000 shares. Therefore, to balance our T account, as you see above here, assets equals liabilities and owner's equity, we know that we need to have a credit entry to additional paid in capital for common stock equal to $40,000. And this balance, the $40,000, is comprised of the 1,000 shares times the difference between the fair value and the par amount, which was 40. And as you can see, our assets of 50 equals our liabilities, our assets equal our equity, and we have zero liabilities. Therefore, the equation balances. One thing I will note with this structure of the T accounts, I've tried to provide something similar on all of your problems, and in addition, same on the homework and quizzes if you have questions that cover this. One thing I will note is that on an exam, you may be given the T accounts with the names of the accounts filled in, such as cash, common stock, APIC, common stock. However, you may also receive blank T accounts, and therefore you will be responsible for knowing what the accounts you're booking the entries to. In addition, within the Chapter 15 homework section on Desire to Learn, I have included a Word document that contains additional tables of these T accounts so you can use them as you're practicing additional problems or on the homework or preparing yourself for the exam. So that transaction, we reflected just par issuance of par value stock. Next, let's cover what happens when you issue stock for non-cash transactions. And in this example, this is when you will stock issued for services or property other than cash. And under this method, you would record these balances by using the fair value of the property or services or the fair value of the stock issued, whichever is more clearly determinable. I would want to point this out that fair value is the key when you're recording stock issued in non-cash transactions. So if regardless of what information I may give you in the example, you need to make sure you are aware that fair value is how this is recorded. As you can see in the example, ABC Company has issued 10,000 shares of $10 par value common stock for land. The fair value of the land could not be determined, but the fair value of the stock is $140,000. Therefore, under this, we would record the fair value of the stock issued is what we can determine. Therefore, we would record the land at the fair value, which is an increase to the asset because we are receiving the land. Common stock, we will increase by $100,000, which represents the 10,000 shares times the $10 par value. Remember, common stock increases and decreases by the par amount. Therefore, we need an additional $40,000 to be reflected in the additional paid-in capital for common stock. And as we previously discussed, this represents the difference between fair market value and the par value of the share times the number of shares that were issued. And as you can see, our assets equal our liabilities plus our equity, 140,000 to 140,000. Again, I just want to highlight that fair value is the key thing to remember in this type of transaction. Next, let's go to stock issued with other securities. So oftentimes you can have one class of stock be issued for a single payment or lump sum amount. So in certain circumstances, a company may issue preferred stock and common stock and receive one lump sum for that issuance. Therefore, in order to know what balances need to be recorded to the common stock account and the preferred stock account, the proceeds received needs to be allocated across the securities involved. One such method is the proportional method, which is used when the fair value of each class of security is readily determinable. There is another method that you can use for this, but we will not cover that in this class. We will just focus on the proportional method. And the proportional method is used when you know the fair value of each class. Going into our example, Company ABC issues the following for a lump sum of $30,000. They issued 1,000 shares of $10 stated value common stock having a market price of $20 per share, and they issued 1,000 shares of $10 par value preferred stock having a market price of $12 per share. The easiest way to look at this is in a two-step method. First, you need to calculate what the aggregate fair value is. And what this is you just need to determine if you multiply the fair value of each shares together, what is the total fair value amount? And as you can see, you would take the common stock shares times its fair market value, or 1,000 times 20, plus the market or the fair market value times these shares for preferred stock, which is 1,000 shares times 12. As you can see, this equals a total aggregate fair value of $32,000. While that is the aggregate fair value, we received a lump sum of $30,000. Using this aggregate fair value, you will allocate the $30,000 lump sum between preferred stock and common stock based on their percentage of the aggregate fair value. First, we will calculate the common stock percentage of aggregate fair value. So what you do in this method is you take the fair value of the common stock, the 20,000, and you divide it by the aggregate fair value amount. So you take the sum of the common stock calculation from step 1 divided by the total that we got to in step 1 of 32,000. This will give you 62.5%. Then, easy enough, you will take the 62.5% and times that by the $30,000 lump sum we received. What this illustrates is that the amount allocated to common stock needs to equal 62.5% of the total lump sum received, which equals $18,750. You can do the next part in one of two ways. We know that common stock got 18,750 and we have a total lump sum of $30,000. Therefore, you could easily just take $30,000 times the amount allocated to common stock and you would get your answer for preferred stock, which is $11,250. But just to be consistent, I will show you the same calculation done for preferred stock. You will be asked on a homework or quiz or an exam to complete a problem similar to this. This should be fairly straightforward, so I hope these are easy points awarded. You may be asked to calculate both common stock and preferred stocks allocation, or you may just be requested to calculate one or the other. As you can see, for preferred stock, it receives 37.5% of the aggregate fair value, that is of the lump sum, which is done by taking the $12,000, which is the 1,000 times 12, divided by the 32,000 aggregate fair value. Therefore, we would take 37.5% of the lump sum received of 30,000 and record that to preferred stock. Therefore, the amount allocated to preferred stock is $11,250. To put that into perspective for journal entries, I do not have T accounts shown, but I will show what they would look like in journal entries. We would receive cash equal to $30,000, and we would debit that, and then we would credit common stock, which is an increase to common stock, and we would credit preferred stock, which is an increase to preferred stock. Next, let's go to cost of issuing stock. One thing I just want to point out right here is there are two differences when it comes to issuing stock and the expenses incurred. There are direct costs that are incurred to sell the shares. If that is the case, those costs incurred are debited to the paid in capital in excess of par, or the additional paid in capital account. This is very distinctly different than general costs, indirect costs that occur, such as management salaries and other indirect costs that aren't directly related to the issuance of the stock. If those expenses are incurred, those are expensed as incurred and do not impact the paid in capital T account. And I will show you an example here of what we would record. As a result of issuing common stock, Company ABC incurred $5,000 in underwriting costs and $1,000 in legal fees. These fees were paid with cash. What is the accounting entry to recognize the fees and the impact to total equity? So we know that we incurred $6,000 total, the $5,000 in underwriting, and the $1,000 in legal fees. As we says up here, these are direct costs incurred for issuing the stock. Therefore, they should be debited to additional paid in capital. As you can see by the T account here, this debit to additional paid in capital reduces the equity balance. This is key to note. This is one of those questions you could get asked on in a circumstance when a company incurs direct cost for issuing stock. What impact does that have on total equity? As you can see from this, the answer to that would be it decreases total equity because you would have to reduce the additional paid in capital account. To provide you an example of the management fees, if the management fees equaled $100,000, then this balance would be recognized as an expense, not a reduction in additional paid in capital. So you would debit salaries expense, which increases the expense, and then you credit the cash, which represents the payment of those salaries. However, I would just like to point out the key thing to note here, that in likely what you will need to know for an exam, is that the difference between what happens for direct cost and what happens for indirect costs, such as management salaries. Before we move on to treasury stock, that will be the end of this lecture. We will pick up on the reacquisition of shares, which is treasury stock, in our next chapter. But first, I would like to just briefly let's go back over some of the key topics and key points I would like to make from today's lecture. So starting back on the first page, I would like to point out to you to make sure you remember this, that common stock represents a residual interest in the corporation. Next, make sure that you understand the difference between the capital stock accounts, which are reflected at par value, and the additional paid in capital accounts, which are reflected at the excess of par value. Therefore, the difference between the fair market value paid and the par value. Another thing to note, make sure that you understand that owner transactions do not flow through net income, with the exception of the one item that we will discuss later in this chapter. Remember that for stock issued in non-cash transactions, make sure that you remember that you use the fair value, not the book value of the property or services or the stock issued, but the fair value in calculating what the correct entries are. Make sure that you understand the proportional method when used to calculate the lump sum and allocating it to preferred stock and common stock. You will not receive an example much more complicated than this on any homework or exam. So if you can calculate this basic example, you should be good to go. And as we just mentioned, I'd like to just remind you to make sure you know the distinction between direct cost and indirect cost issued or incurred for issuing stock and how those are accounted for. That is all I have for today. You can use this information and begin to start working on your homework. There are several questions on the homework that this would apply to. However, I would probably prefer that you move on to the next lecture recording, as some of the concepts covered in this first section over common stock will play a significant part as we get into the treasury stock section and then the preferred stock and dividend section, which we discussed in our third lecture. That is all for today. If you have any questions over this material, please do not hesitate to ask. You can reach me via email or by phone. I would prefer, if you would like to speak over the phone, that we set up a time to do so. But please do not hesitate to ask if you have any questions over the material that we cover today. As a reminder, for purposes of your homework, quiz, and exam, you will only be required to understand the concepts and information that we've discussed in the lecture and the note handout packet that I have provided. However, I would encourage you to read the textbook over this material, as it will definitely further your understanding of some of these key concepts that we have discussed. Thank you and have a good day.